Okay, so good morning, everyone. Welcome to the macro snapshot. We are Wednesday, February the 26th, 2025. I thought, guys, there's not a huge amount of data going on, so I thought we'd just have a look, just sort of pull back a little bit and just see what's happening in the US with the bonds and also Europe, just get a bit of a sort of an overview. Obviously, today we have NVIDIA earnings at 4 p.m. I think the market will probably stabilize a little bit today and just wait and see what happens with NVIDIA, especially with their forecast for AI data centers, the new chip demand, supply constraints and whatnot. But that's for 4 p.m. Okay, so what we've been seeing here, we've seen quite a lot of sell-off in the US yield. So I think we're now, as I said, stabilizing. We got to the bottom of this range in the 2 year. And that makes sense because over the last, let's say, 4 or 5 trading days, we've had relatively weak ISM services. We had a conference board, which was kind of weak yesterday, which the market didn't like at all. We also had some lower retail sales. So all in all, the market is trying to sort of think about, digest, price in this idea that maybe there's got to be a growth slowdown. Now, the question we're trying to figure out is this just a scare? Is this just sort of a symbolic thing, the market pulling back a little bit, or is there actual evidence? And I think at the moment, the market's pulled back a little bit, and now we'll probably wait for sort of hard evidence. So yes, we had, as I said, we had a conference board, which was a little bit weak in terms of confidence. We had the ISM services, but they are surveys. They're not actually hard data. And, I think the market at this point really wants to see the non-farm payrolls, wants to see retail sales. The next print also wants to see maybe durable goods, factory orders, industrial output, all of this kind of thing, just to see what's happening. And next week we do get a few more sort of data points. We get ISM manufacturing, which is the most sensitive one. Of course, we get ADP. We get also the jobs number. So I think next week is going to be important just to determine the next direction, whether it's just a growth scare or whether actually there's a growth slowdown. What we did get overnight, the House, the U.S. House, and the passed basically what they call the Republican budget blueprint. And essentially that's just, it's not actually the budget, but it's kind of like a pathway, a guide to what the goals are for the Republicans. And it's clear that they're looking to save, $2-3 trillion in tax cuts. So basically, the Trump administration wants the tax cuts to be extended. There is scheduled to expire. Trump wants those to be extended. But in order to pay for those, they need to sort of cut back expenditures. And last night we saw in the so-called budget blueprint that they're looking to cut $2-3 trillion of aid of Medicare, but maybe, or even just sort of in other programs. So that's going to be difficult politically to cut $2 trillion of Medicare. So we'll see how that goes. But the direction of travel here is pretty clear. The big picture here is that Trump and Bessent of the Treasury, they want the 10-year yield lower. They don't really care what the Fed's doing at this point. They're basically saying we want the 10-year yield lower. We're going to try and talk that down. There's been a lot of talk about trying to get the Mar-a-Lago Accord, going back to the 80s with the Plaza Accord, try and get some grand international alliance for all the developed world countries to, push down the value of the US dollar. We'll see if that happens. I don't really see that that's a benefit at this point for the US's trading partners like China and Europe, especially when, Trump has been so aggressive. But basically, it does seem that if you sort of step back and look at least what the goals are, maybe not the reality, but the goals of this administration do seem to be cutting the deficit, cutting spending, getting inflation down, getting the 10-year yield down, and at some point maybe allowing the US dollar to weaken over the medium term to try and aid exports and whatnot. So at the moment, that's the situation. And as I say, the market has kind of digested that a little bit symbolically this week in the last few days, but also with some of the survey data being a little bit weak. So we have seen the yields come down. But I do believe that at this point, for example, in the 2-year yield, that's probably reached, I don't want to say the maximum on the downside, but that's, probably fair value at this point. What we can also see, though, if you look further out the curve, is that something like the 30-year and even the 10-year yields here, you see they've fallen off quite a lot more. So this is kind of interesting. If we actually just look and just see what's been happening in terms of the yields and yield curves and whatnot, we can see that there has been some repricing in terms of the Fed. So if we actually look here, we can see just where we are with the Fed, and we can see that, let's say, by the end of this year, so that's the December meeting, we've now got 2.1 cuts priced in. So that's 2 cuts. So that's definitely a bit more dovish. And if we go on the intraday chart, this is going back about 4 or 5 days. So you see it's just like a tick chart here. This is giving you the amount of basis points which the overnight interest rate swaps have priced in for the Fed, how much the supposedly the market thinks they'll cut by December. And so it's just kind of interesting to see that if we go back, just a few days here, we can see that the market was pricing at about 1.5 cuts. So you see here about 37 basis points, and it's just been a slow grind downwards. Again, it was like the soft retail sales. We had the conference board, et cetera, et cetera. And this has just allowed the market to kind of price in essentially another, 10, 15 basis points. It's now kind of stabilized over the last kind of overnight sort of session here. But essentially where we're at now is 55 basis points, which is just over 2 cuts priced in. And essentially what the market is, and that makes sense because the market is saying, hey, maybe Trump will be spending less, the deficit will come down, they're going to cut jobs. We're seeing people, losing the government jobs a lot. And some of the estimates I've been reading in the last 24 hours is talking about anything no one really knows, but maybe sort of, 30 to 50, even 100,000 jobs. And some of the logic is that a lot of these government workers, they also give out contracts. And so what, some commentators are saying is that for every government worker who's fired, that sort of might affect one or two contractors, external contractors. So if you start talking about maybe 100,000 government workers, then you start adding on the sort of the impacts to external workers and contractors and government suppliers. Suddenly you're talking maybe 2, 3, 4, 500,000 people affected in terms of jobs, and that suddenly means that maybe in the next 2, 3, 4 months we could start to get some payrolls, some non-farm payrolls numbers really coming down to zero or maybe even negative, and that would get the market's attention and for sure would justify this idea that we could be going into some kind of recession or even just a mild recession. And certainly maybe that the Fed might want to be cutting sooner and more aggressively than the market had been pricing in. And that explains a little bit just some of this repricing down to 2 cuts. If you actually also, you can see here, if you look at something just like the SOFR curve, kind of interesting just to see, this is where we are today. This is the live data here. So this is all the implied yields of the SOFR contracts. Each dot here represents, a dot going into the future, 3 months going into the future. And if you look at the blue number here, this is the from 1 week ago. And what you can see is that at the very front of the curve, so for the next 2, 3, 4 months, not a huge amount has changed. But as soon as we start getting out to, a bit later on in the year, we can see, for example, there's March, and then we can go into, what's that? That's April, et cetera, as we go further out into the year. And getting into sort of, early 2026. So this is the end of 25. This is the beginning of 26. You can really see here that the implied yield has changed quite a lot. You see it's fallen down. So this is the yield on the right. And you can see that, it's changed by anything here, 10, 15, 20, in some cases 25 basis points. So definitely a sort of a dovish repricing. At this point, as I say, I think the market's probably had enough for the last few months. So for the last few days, the yields have come down quite a lot. And now, as I say, we'll probably have to see NVIDIA and start getting some hard data, which will start to get a little bit more next week. And just to see how that's gone over the curve, kind of interesting to see here where that's changed. So this is the actual yield curve in the US. And what we can see here is that, the yields, again, if you look on this lower panel, you can see the yields have come down quite a lot, anything again from 10, 15, 20 basis points. But really, the front end of the curve, yes, it's repriced. And you see here, let's say 6 months. So this is really what the Fed controls here. You see the 6 months, 1 year, and even out to the 2 years. So for sure, the yields have come down. But really, a lot of the more aggressive sort of repricing has been anything really in the belly and the long end of the curve. So you see here, going to the belly, the 5s, 7s, 10s, they've come down, 22, 25 basis points going out here, the 20 and the 30 year. So you can see here that once you get there, it's been a parallel shift out from the belly of the curve and the long end of the curve. And what that's telling me is that the market is saying, yes, the Fed has the ability to cut a little bit more, but not super aggressively. And really what this is telling us is that the market is saying that economic activity in the future could be slowing down. And that's reflected in the belly or the long end of the curve going down a little bit harder. So then if we go out and just look at some of the yield curve charts, you can see here, let's say this is the 10-year, but let's look at the yield curve. So let's say looking at the 2s, 30s, you can see here that just over the last few days, it has started to flatten a little bit. So there's the 2s, 30s there. And if you look at the 2s, 10s, you can also see it's been flattening a little bit. Again, I don't know if it's got too much further to go. But it's definitely what it's signaling is the market saying maybe this lack of spending by the government, this deficit cutting by the Trump administration will eventually, and firing people will eventually lead to a slowdown in economic activity. And what's interesting is actually that of course is being reflected in the US dollar has been a little bit sort of weaker over the last few trading sessions, and we can see here this is the dollar index, which is quite Eurocentric. It's about 58% euro. But still, we get the point here that the dollar index has been kind of grinding down, just as those yields and the yields differentials are coming down. Now, the question here for the dollar is, the dollar index does it have, more downside? I think it's a nuanced situation. So if we start looking at Europe, let's now look at the European situation, which is kind of interesting. And again, I want to sort of look at the yield curve. So we saw in the States that the yield curve has been kind of flattening, just in this idea that government policies there might slowly start slowing down the economy. But if we actually look at it's interesting to look at the German yield curve here, because if we look at the German yield curve, let's say it's like the 230s, you can see that actually it's been steepening over it's been grinding up and getting a little bit steeper. And if we look at the twos, tens, you can see, that's also been slightly steepening. So we have a situation where, over the last sort of couple of 2 or 3 weeks, the German curve has been steepening, indicating maybe less aggressive ECB cuts and maybe even more sort of like slightly less weak economic growth, so slightly stronger economic growth, in contrast to the US, which has had a flattening yield curve, which is the opposite. And this is interesting because seems to be saying that this whole idea of US exceptionalism, the idea that the US is definitely outperforming the rest of the global economies, it's starting to turn around a little bit. And it's not as though China's doing super well and Europe's doing super well, but there is a bit of money flow going into the European space, especially. And you can see that if you look at, let's say, a couple of indices here, we can look at the Germany index here, the DAX, and what you guys will notice, you've probably noticed already, and for sure, things like European banking stocks are absolutely going crazy. And you can see here that the Germany index, is doing pretty well, and it looks, it's up today. And then you look at the Euro Stocks 50, also up strongly today. So it looks like it's starting to retest the highs. So what's that telling us is that there's definitely money flow going into Europe, and that's based on this idea that because of Trump's foreign policy, the Europeans seem to be coming to the idea that they need to radically overhaul their defense. So a lot of money is going into European defense contracts. We've had people like Prime Minister Starmer of the UK and the new Chancellor in Germany, Merz, basically saying, listen, we've got to start spending a lot more of our GDP on defense, maybe up to 2, 3, 4, 5%. We saw Starmer of the UK saying they're going to increase defense spending up to 2.5% of GDP and cutting overseas aid. So the point is, a lot of money seems to be going into the defense sector, or will be going to the defense sector. At the margin, that's good for the overall economy, in theory, for Europe. And secondly, a broader thing is that Trump, and especially that speech by J.D. Vance at the Munich Security Conference about a week ago, it got everyone's attention. And essentially, there seems to be a realignment underway that the Europeans have understood that the Americans, they just treat them like mercantile. It's going to be a mercantile kind of relationship rather than a sort of a geopolitical or security relationship. And that seems to be sort of ringing alarm bells in Europe, that they need to start spending more on infrastructure, on AI, on technology, and maybe sort of liberalizing their labor markets, basically trying to sort of re-stimulate the old continent, Europe. And so I think what's happening here is that there's a lot more talk, even in fiscally prudent countries like Germany, of spending more on fiscal, like sort of more fiscal spending to sort of stimulate Europe. So I think the market is picking up on that. I'll just have a sip of tea here. And that's the situation. Of course, this could change quickly. Any kind of sort of negativity with the Russian-Ukraine situation. I mean, just talking about that, we had some talk yesterday that the Europeans themselves were trying to do a counteroffer for sort of rare earths and minerals in the Ukraine. So Europe definitely seems to have sort of been woken up a little bit by Trump's sort of unorthodox policies. And we see this a little bit reflected in the euro. And I have a little chart here, guys, which is kind of interesting, just of what the euro has been doing. This is a short term, just after the German elections. And so you can see just this is Euro USD. And you can see after the elections here, when it was clear that there was just going to be a two-party coalition. So nothing too complicated, a pretty clear alliance, and the ability maybe to get fiscal spending done. So the euro ripped pretty high there. But then but in order to sort of take off the fiscal brake and basically unleash some of the deficit spending, they have to get a two-thirds majority. And then when it was clear they didn't have that, euro sort of softened a little bit here. And then we had the comments from Merz, the new chancellor, basically saying there was an effort, as you can see here, to boost defense spending, maybe up to 200 billion euros. So the euro then liking that. So it's interesting just to be looking here at what the euro has been doing, really reacting well to any talk of fiscal stimulus and sort of government sort of clarity. And if we actually just look at the chart here, so let's look at the euro chart, which is here. Pretty interesting point. It has had a significant bounce, but again, I do think in this 105.30 area, 105.50, 105.30, I think this is going to be difficult to pierce because at the end of the day, the US dollar, maybe that's the medium-term plan, is to weaken it, to allow it to weaken a little bit. But at the end of the day, even if the US possibly is facing less government spending, less deficit spending, so a little bit of an economic slowdown, it's difficult to imagine a world where the US significantly underperforms Europe. It may be that Europe and China might catch up a little bit, but the idea that the US will significantly underperform, I think that's a sort of a medium-term story, and it's also a story which we need to see played out in the data. We need to see the data. Is the US employment situation weakening? Is retail sales weakening? There are some signs of that, some cracks. Anyway, just to say from a trading perspective, I think that if the euro gets up a little bit. I mean, where are we trading now? 104.8. I think, just a little bit higher would be a pretty interesting, good risk reward for a short here. We're also seeing in Japan. I'm just talking about the US dollar here. Again, it seems to be stuck a little bit USD JPY at this 50% fib retracement. You see, I signaled that yesterday as well. Pretty important level here. Having said that, what is interesting is that the story about the Japanese yen is pretty interesting. This idea that they're both a safe haven, they're relatively protected from tariffs, and thirdly, of course, we do have this story that the BOJ at the end of the day seems to be one of the only developed market central banks, which is actually going to be hiking once or twice this year. So I think again, it's difficult to chase this lower, but potentially if this gets up to 152, again, that would be a pretty attractive short. Or if you want to be a little more aggressive, maybe 150.3, or even this one here, 150.7. Personally, I'd like to see it go up a little bit more, but it definitely looks as though there could be an exceptional story with the yen. In terms of other currencies, you've got Euro JPY, again, looking quite weak. The JPY is definitely the strong one. It was interesting looking at the price action yesterday because we definitely had some outperformance of the European currencies. In the middle, we had things like the safe havens were doing well. In the middle, we had sort of like the pound and the euro. And then definitely underperforming was the Australian dollar and the New Zealand dollar and CAD. And just talking about CAD, CAD's been very, very weak. You can see here pushing higher. Sorry, the US dollar is pushing higher against CAD, and that's just because the tariff deadline is approaching, towards this weekend. And Trump at this point yesterday reiterated that Trudeau was the governor of Canada, not the prime minister. And essentially saying that yes, he had, was intending to put tariffs on. So for sure, that's been reflected in the market. If that doesn't happen, I think USD CAD could definitely have a pretty quick reversal. We saw a huge reversal on the non-imposition of tariffs a couple of weeks ago. There's huge red candle here. We're not yet at those levels, but for sure, any imposition of tariffs could lead to further weakness in CAD, could get up to maybe 144 or so. But again, it's difficult because this is a headline risk. What you're looking for here is to try and enter at good levels and take your money and run before you get rolled over by sort of a headline. But definitely the pain of tariffs at the moment seems to be being taken by CAD. What's interesting is that Trump hasn't spoken that much recently about tariffs on Europe. He mentioned copper, which we'll talk about in a second. But in terms of Europe, that's still the risk. The market's forgetting about that a little bit. Any mention of, sort of auto tariffs, again, he did mention it last week, but any sort of, more serious kind of talk could soon get the euro down. Just quickly, guys, because we're starting to run out of time here a little bit. In terms of tariffs, we did see Trump last night at about, well, let's say afternoon, about 4 o'clock, say that they're now studying copper. They want to bring copper industry back to the US, thinking of tariffs, no exceptions, blah, 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 the usual kind of aggressive talk from Navarro, who's the trade representative as well. And you see here on the futures, you see, a huge 400 tick pop in the price of high grade copper, the HG on the US contract here. Interesting though that it did fail at the fib. If you look at this big fib retracement level here, so going back here to the middle of May, it did fail at the 61.8 fib, which is sort of more or less where it has been failing 3 or 4 times over the last 6 to 8 months. So interesting here that that was a bit of a sort of a squeeze on those tariff headlines, whether the market will follow through. What we've seen with Trump tariff headlines and commentary is that there's been initial pops and then increasingly faded. So this is maybe the initial pop. Looks like it's fading here. Gold, just talking about the metals here, had an off day yesterday, just sort of stuck in the middle a little bit here. Difficult to interpret. We still have real yields high, so gold potentially shouldn't, quote unquote, be up here. But at the end of the day, it is a safe haven. We know there's huge rotation in the central banks buying gold. So again, it's just a question of, it looks as though it's still in a very, very strong bull trend. It's just a question of trying to figure out what could be an attractive retracement. Is it, like a fib retracement here, 38%, or is it maybe a more substantial one down to like, 28.90 or something like that? It's a difficult one to figure out. Silver, though, yesterday, weak and still very weak, huge engulfing red candle here. So again, silver, which has more industrial usage, about 55% is industrial usage. So that's still a bit more reactive to this idea of softening in, sort of the global and US economies. Just finally, guys, just want to have a quick look here at the equities. We have a bit of a bounce back this morning. If we look at the VIX down a little bit, and I just want to show you the curve, which I think is always kind of useful to have a quick look at. Whoops, oh, sorry, I've got, let's have a look. Yeah, so there's the VIX curve. So you see from a week ago, as I was been saying, it was in contango, so showing not a huge amount of risk in the spot and then the front contracts. Yesterday, which is the blue, we saw that had flipped into backwardation, signaling sort of risk off, so kind of risk. Therefore, the spot was above the first futures. What we've seen this morning, this is a live price, as I say, about 7:45 here, is that the front, the VIX spot is actually down a little bit compared to yesterday, as is the whole futures curve is down a little bit, but still trading well above the prices from a week ago. And still you see that the spot is above the first VIX, the first month for the VIX futures, which is a sign that there is still some risk in the market. And we're seeing just the spot here trading, what's that about? Almost up at 19. So still relatively elevated. We're quite a long way now from the 11s, 12s, and 13s, where, the VIX is settled at a slightly higher sort of price, more like the 16, 17, 18, 19, 20 kind of range. So signaling that there's still a little bit of nervousness in the market. And that also could just be because we have NVIDIA this afternoon. So let's have a quick look just at the equities, having a little bit of a bounce this morning. Again, the bouncing off, there's like a sort of moving averages here. We can throw on some EMAs. So you can see here if it's going to come up. Did I put those EMAs up? There we go. So you see here, just around about this horizontal support, that's the 100-day EMA there. If you look on the NASDAQ, I think it was actually clearer. Yeah, so you see here, just poking through the 100 EMA here, fib retracement level as well on the ES. I think it was actually go to the SPX here, if my memory serves me correct. Yeah, so you see here from this most recent sort of price action impulse, just stopping here on the SPX, which is often a better one to look at than the futures in terms of technical. So the SPX here at the 100-day exponential moving average bouncing, which also coincided with some sort of horizontal support, and also the 61.8 fib retrace from this sort of level here. So, that's a reasonable place to bounce, probably good for an intraday quick scalping day trade there. But still, we've had three day down days at this point on the SPX. I still believe that, we could be getting down here a little bit more just to test that sort of Trump range, that opening gap range. So that's my base case. But, of course, it's going to depend on NVIDIA. So let's have a quick look at the NVIDIA just to get some context here. So Nvidia again echoing what's been happening with SPX, 3 down days here. I mean, a gap down here on the DeepSeek sort of news. The news, but also had some problems a few days ago. This idea Microsoft was maybe canceling leases on AI data centers. So really, it's going to be all about the forward guidance, the demand for data centers, and also just whether their latest generation of chips called the Blackwell 200, I think, whether there are any supply chain issues with that delivering it, and forward guidance. If we get very strong forward guidance, strong earnings, so some kind of green light that the AI space, there's plenty of capex happening. For sure, in Nvidia, if that bounces, that could lead to a little bit of a bounce in the general equity market. And who knows? Maybe we'll get a lot of things overturned, which we've seen in the last few days. Maybe we're going to get Fed funds futures pricing coming down. We're also going to get, maybe the Mag 7s going up. So here's the Mag 7s here, ETF, which index, which has come down. That could, of course, push up, and we shall see. So that we'll leave it at that. Have a great day. Hope that was useful, and we will keep on talking. Thank you.